Growth stocks are the most exciting investment in the entire stock market. These are stocks that can make you a fortune overnight. For example, this stock that increased nearly 200% just this year, and we'll be talking about it and other stocks just like it so you can get in before the stock price increases. So there are 15 steps that I use to decide if a growth stock is worth buying or not, and I usually print them out on a checklist like this. This lets me evaluate any stock in around 60 seconds once I have the information. And since this video is sponsored by Stockopedia, we'll be using their stock research platform to assist us in our hunt. Now, normally I like to find a stock first and then use this checklist to figure out if it's worth buying, but since a company is willing to give me their super-powered stock research platform, I figure I'll use that to save some time. The first question we need to answer is the company growing revenue at 30% or more per year? And as we go through these questions, we're going to be putting a yes or no in each column, and at the end, we want to have at least 12 yeses to invest in a stock. So Stockopedia can help us answer some of these questions even faster by creating our own screener that automatically checks every single stock in the stock market and sees if it matches our criteria. So in our new stock screen, I'm going to add a rule that their sales growth needs to be greater than 30%. So I'll save that, give it a name and a description, and now it's going to give me all the companies in the stock market that are growing at greater than 30% per year. Check. Number 2, does the company have more assets and cash than debt? The reason this is important is a lot of companies can actually fake their growth by taking on a bunch of debt and just using that to market their products super aggressively, which will cause the company to grow, but it's not going to cause them to grow in a sustainable way. By only investing in stocks that have a low debt ratio, we ensure that they have some room to maneuver if they run into some hard times. So we'll add that to the stock screener next. I also added a filter to only focus on companies that sell at least $200 million a year and have a market cap greater than $5 billion. No penny stocks here. So to figure out their debt ratio, we can look at what's called the gearing ratio, which Stockopedia explains here is your debt to equity ratio, a measure in how encumbered a company is with debt. So we want that to be less than 50%, which would be more debt than assets. Check. Number 3, is the company free cash flow positive? This is an interesting one because I'm focusing on cash rather than profit. Profit is actually more of an accounting term. You can be profitable while still losing money every single year as long as you have assets, for example, that go up in value. Cash flow, on the other hand, never lies. If you have more cash coming in every month than is going out the door, your company will never go bankrupt. And when we're dealing with higher risk growth companies like this, cash tends to be king. With cash, you can buy back the stock if it drops too low. You can buy out smaller competitors to grow even faster. And you can just reinvest back into the business. And this isn't just me saying this. Warren Buffett, who I consider the greatest investor of all time, agrees. If you remember the Enron scandal of 2001, they were incredibly profitable on paper every single year, but their cash flow didn't lie. They were losing money each year. And so investors who focused on profit ended up losing out, while cash flow investors ended up avoiding that complete scam. So we'll search for free cash flow, and we just want their free cash flow to be greater than 0. They shouldn't be burning more cash than they bring in each month. Check. So now we're only 3 questions in, but we've already filtered out the entire stock market down to just 39 stocks that meet the results that we want to see. And we're going to be filtering these down even more to find only the best of the best stocks to look into, which makes sure that we don't waste time looking at companies that aren't going to give us a good return on investment, that are growth stocks that aren't faking their growth and that aren't very likely to go bankrupt because they're producing cash flow. But which one do we invest in? Well, this is where we get to the fun part, where we get to act like stock detectives to understand what's really happening in these companies. But first, there's a relatively quick way we can filter out the majority of these stocks that are on this list, which is question number 4 on the list. Does the company benefit from a broad growth trend? A growth trend is something that's happening in the market where a group of companies are all benefiting together from some kind of change. An example of this today might be cloud or data or AI. Each of those industries is growing already by itself. So if you combine a growing company on top of a growing industry, that can cause the company to exponentially grow. So some of the companies on this list you may have seen me talk about before if you've seen my monthly portfolio review calls. So let's look at Snowflake, CART, REXR, and SWAV. So first off, we have Snowflake. Does Snowflake benefit from a broad growth trend? Well, we can quickly read a summary of the company. It says right here, Snowflake is a data cloud company, and their platform is the technology that powers the data cloud. Well, both data and cloud are broad growth trends, so Snowflake passed the test. Let's check the next one, CART. CART is the company that makes Instacart. And if we go down to their profile summary, we can see that they're a grocery technology company and that they offer software as a service offerings targeted at retailers. Is this a company that's benefiting from a broad growth trend? Well, digitization could be a broad growth trend, so I would say that is a point in favor of them, but at the same time, they're also competing with e-commerce companies. So in that case, it might not be a growth trend. In this case, it's kind of neutral for me. I don't really see a major growth trend that Instacart is going to be able to ride at this point. Next, we have REXR, Rexford Industrial Realty. Their profile summary says they are a self-managed real estate investment trust operating in Southern California. Is there a broad growth trend in the real estate market? I wouldn't really say so. There haven't really been any innovations in that market, and it's a very cyclical market. It tends to go way up and then way down just depending on what's happening in the general economy. And then stock number 4, we have Shockwave Medical. The profile for this one says they are a medical device company of cardiovascular disease, heart disease. So is this company riding a broad growth trend? Well, medical technology is always improving, but I wouldn't say that there is sort of a growth trend behind that. It tends to be very sparse and intermittent, where you have one company that invents something revolutionary, they blow up, but it doesn't really help all the other companies in the industry. So out of these 4 stocks that I looked at, the only one that I would say for sure qualifies as benefiting from a broad growth trend is Snowflake. So Snowflake checks the yes column for number 4. And now we get to the really interesting questions. Questions 5, 6, and 7 are less about the specific numbers around the company and more around the story of the company itself. Does the company have a moat? Could they dominate their niche? And are they founder-led? Here's why those are so important. Warren Buffett talks about the idea of an economic moat, basically something that protects your company from all your competitors coming in and stealing your business. A moat is something that it's not easy for a competitor to just copy. So for example, if you were a railway and you own the rights to the only railway in a given state, that would be a moat because another company can't just come in and build a new railway without going through the government first. Or if you had a patent on a specific pharmaceutical or technology, that would be a moat because others can't copy you. On the flip side, there can be advantages your company has that aren't really an economic moat. So in Snowflake's case, does Snowflake have an economic moat? In the profile summary, they explain that Snowflake is a company that's inventing the data cloud. If you think back to early data, it was originally written down on pieces of paper, then it moved into basic spreadsheets and tables on computers. Then it moved into more advanced databases, then data warehouses, data lakes, and eventually into the cloud. Snowflake represents the next order of magnitude improvement called the data cloud, which allows companies to effectively outsource their data management, empowering them to use technologies like AI and machine learning, build applications that make use of that data, and even share that data with other companies. That technology itself can be an economic moat for Snowflake because it's secret and no one else can see it. But another big advantage Snowflake has is their ability to let customers collaborate with each other. Imagine a bunch of pharmaceutical companies are all using Snowflake's platform and sharing data with each other on a new drug they're manufacturing. Well, one of those companies probably isn't going to leave Snowflake's platform for a competitor because they lose access to everyone else. That is a network effect, where having more people on the platform makes the platform itself more valuable, and it's a form of economic moat. So that's a check for number 5. Number 6, could the company reasonably dominate its niche? This item on the checklist is based on the investing philosophy of Warren Buffett. Warren Buffett seeks out consumer monopolies with a product or service that is unique and difficult to reproduce by competitors. What that means is they have an economic moat that their competition can't get into, and they operate an effective monopoly in their own space. A monopoly is where one company basically owns an entire market. All the customers have to come to them to get a specific product. Now, when monopolies get too big, the government will eventually break them up, but the goal of any company is to be a monopoly, at least in its own small corner of the world. Now, Snowflake operates in the data cloud, but there's a lot of other companies that operate in both the cloud space and the data space who would love to get in on the action. There are some other very competitive companies in this same niche. In fact, if we go to the compare with tool in Stockopedia, we can compare Snowflake with one of their biggest competitors, Amazon. Amazon is obviously a much larger company that makes way more money than Snowflake does, but the trade-off there is when you invest in Amazon, you're also investing in their e-commerce platform, their video production platform. You can't really invest in just the data piece. But realistically, do I think Snowflake is going to completely dominate the data niche? Probably not, so I'm going to put an X for number 6. Number 7, is the company founder-led, or does the leader have a proven track record? One of the most important parts of investing in a company is who is actually steering the ship. Why is it that some companies grow exponentially year after year after year, while other companies flounder, despite the two companies starting in the same place? Well, a lot of it comes down to the people behind the company. Well, Snowflake was originally founded by 3 data experts, many of them coming from Oracle. And while none of these individuals is the CEO of Snowflake, they're all still involved in the company. Now, ideally, I do generally like to see the founder as the CEO because no one has a more vested interest in the company growing than the founder. But there can be a reason for bringing in an external CEO if they have way more experience than the founders. And that's what's happening in Snowflake's case. Snowflake's CEO is Frank Slootman, who was the CEO and president of ServiceNow for 6 years, and he took that company public from around $100 million in revenue all the way up to $1.4 billion. He was also the CEO of Data Domain Corporation, and him along with the rest of his leadership team bring a ton of experience on board. So that's going to be a check for number 7. And now I'm going to show you how to look below the surface on these stocks and actually get into the numbers that matter behind their future performance. Question number 8. Does the company produce recurring subscription revenue with flat or improving margins? So if we want to look at something like Snowflake's revenue, we can just go into accounts, income statement, and get all their different reports pulled into one place directly within this platform. And we can see just how quickly Snowflake's revenue has grown every single year. But Snowflake actually manages to do that without having recurring revenue. So that's a no for number 8. But here's why recurring revenue is so valuable. The very first question we asked is a company growing their revenue at 30% each year? The reason for that is growth stocks that increase their revenue year after year after year see that growth get compounded over time, causing their value to go up exponentially as well. The risk with investing in growth stocks is that growth rate going to slow down before the value can catch up? So let's look at 2 different scenarios here. Scenario 1, you're running a shoe company that sells $100 million worth of shoes every year, and they want to grow 30% next year. Well, that means next year they have to sell $130 million worth of shoes, 30% more than last year. Now let's imagine it's a subscription revenue company, maybe a software as a service company. They sell $100 million worth of software as a service this year, and they want to grow 30% next year. Well, that $100 million just carries over from last year because it's recurring. So they only have to sell $30 million more to grow 30%. And let me tell you, it's a lot easier to sell 30 million than 130 million. And so when you have recurring revenue, that is growth that is built into the business itself, and it makes it a lot easier for growth stocks to continue to scale. It's not a deal breaker for Snowflake, but it would be nice to have. The other piece is we want them to have flat or improving margins. Margin is basically what percent of the money that the company brings in do they turn into a profit. A lot of companies like Amazon, for example, went for 20 years without making any profit, even though they were churning through tens of billions of dollars in revenue. And that's because it cost the same amount to run the business as they were bringing in every year. And that's an okay strategy sometimes. You can have negative margins, meaning you lose money each quarter, if you're investing in the business and growth. After all, Amazon is now one of the most valuable companies in the world, despite not making a profit for 2 decades. So here's how you can find the margin using Stockopedia. You're just gonna go down here to the operating margin, and we can see the operating margin for all these different years here. So back in 2019, it was negative 192%, then negative 135, negative 91, and you can see that it's kind of followed this improving trend up until we get to 2023 when it's been negative 42.6. This means that Snowflake is losing money. They are not a profitable company, but at the same time, they are losing less and less money every single year, meaning they're becoming more profitable as they scale. So this means as long as they continue growing, eventually they'll become profitable. Now, if this was going in the other direction, that'd be a cause for worry. And by the way, if you're interested in trying out any of the tools I talk about in this video, you can get a free 14-day trial by signing up using the link in the description. Question number 9, does the company have diversified revenue? What this means is we do not want any one customer or a couple customers to make up more than 25% of the company's revenue, because if that customer leaves, your whole company is going down. Now, in Snowflake's case, we can see that they have 402 customers who spend over $1 million a year in product revenue, so not a concern for Snowflake. Check. Number 10, is the company profitable excluding money they are reinvesting? This question is super important. Now, I mentioned earlier that Snowflake isn't actually profitable. That's true. They are losing money every year. But I also said that is okay if they're reinvesting that money back into the business. But if the company is just not profitable because they don't make enough money or it's just a bad business, those aren't stocks we want to invest in. So here's how you can tell if a company is non-profitable because they're reinvesting back into the business, or if they're just not a very good business that doesn't know how to make money. So there's 2 numbers that we're going to look at in this case. Snowflake is a tech company, which means how they reinvest back into the business is primarily through research and development. So the first thing we'll look at is Snowflake's net profit. They lost $797 million this year. So let's see how much of that went into R&D and how much of it went into other areas. Well, this is super easy to do on Stockopedia. We just open up their income statement, we scroll down to their research and development costs right here, and for 2023, they spent $788 million on research and development. What that means is if Snowflake just stopped investing in their technology, they didn't develop anything new, the company could be profitable tomorrow. They're just choosing not to be because they know they want to take a longer term perspective and grow and take over the market. This is very different from a company that is losing money and has no hope of ever bringing that that back. And add on to that their second number, their selling, generative, and administrative expenses. Obviously, if you have a company, you're gonna spend some of that money on marketing and selling. Snowflake is spending nearly $1.4 billion on selling. Obviously, they need to keep on doing that if they want to keep growing. But if Snowflake's only goal was to make a profit this year, they could probably cut that back by 50%, and all of a sudden they'd be making $800 million worth of profit in a year. So that means Snowflake is not losing money because they're a bad business. They're losing money because they're choosing to invest in selling and developing new products. And let me just say, this is so much easier to do in Stockopedia than actually going out and finding this information on my own. For anyone who hasn't had to try and find these numbers manually before, I'm gonna do a quick time lapse with a timer on the screen showing how long this normally takes. And time. That's how long it took me to find their R&D expenses for 2024 by manually going and looking in the reports. And that's coming from someone who does this all the time and knows exactly where to look. So question number 10, is the company profitable excluding money they're reinvesting? Yes, that's a check. Now we get to something called the Big Four check. The Big Four are a set of 4 questions that I ask myself before investing in any stock. Now, some of the other options we looked at before, they don't have to be true for the company to be a good investment. They just have to have most of these truths. But with the Big Four, every single one of these has to be true or I would not invest in the company. So question number 12, do you understand the company's business? Well, Snowflake is offering the data cloud. They often onboard new customers starting at the developer level and then expand them over time using their ridiculous 142% dollar-based net retention rate. As more and more companies move into the cloud and more data is produced, Snowflake's customers will only spend more money with them every single year, and they'll have more customers on the platform each year. Check. Number 2, have you listened or read their transcript to the company's latest earnings call? You want to know the most overpowered way to become a great stock analyst? Just listen to the earnings calls that the company puts out. These are calls where the leadership of the company, the CEO and the CFO, will literally walk through how the business is doing and respond to questions from stock analysts. So I had previously saved a note in here with the link to their latest earnings call transcript, which I read through back when they first announced it a few months ago. These transcripts can be pretty long. I'm scrolling through right here, showing through how long it is, but they are a wealth of information and will 10x your knowledge about any given stock extremely quickly. Number 12, check. Number 13, can you explain your buy or hold thesis for the stock in 2 to 3 sentences? I believe that unless you can explain why you're investing in a stock simply, you don't understand it well enough. Personally, I also like to write this so that it can fit on a single note card, and here it is. Here's my thesis for investing in Snowflake. Number 13, check. And number 14, do you know what would cause you to sell the stock? It's great that you know why you want to invest, but you have to have a reason to sell the stock later. Deciding ahead of time what would cause you to sell the stock helps take all the emotion out of the picture and lets you focus on what actually matters to the company's performance. So I have 5 reasons that I would sell out of Snowflake. Number 1, a competitor comes out with an equivalent product and starts winning Snowflake's customers. Number 2, Snowflake's costs increase dramatically, either from the cloud providers all working together to increase costs or the government coming in and regulating something. Number 3, their growth stagnates or drops on an absolute dollar basis. They should continue to grow more and more every quarter. And I understand that percentage growth may decrease just from the law of large numbers, but the absolute number should continue to increase. Number 4, if leadership is ever untruthful about anything on an earnings call. I mentioned before how much I rely on earnings calls to form my understanding of a stock, and so if I can't trust leadership, I can't trust investing in the stock. And reason number 5, existing customer usage trends downward, as measured by the dollar-based net expansion rate. Snowflake has a dollar-based net expansion rate of 140%, meaning for every dollar a customer spends this year, they'll spend $1.40 next year. That is built-in growth that is driving a lot of Snowflake's increase in size every year. But if customers start to spend less money on the platform every single year, that means 1, there could be an issue with the product, and 2, it means their growth is going to slow in the future. And so that'd be a reason for me to sell. Number 14, check. Which leaves us to one more question to answer before we decide whether or not to invest in this stock. But not everyone wants to invest exactly how I do. And so you can also come into Stockopedia and look at investing screens set up by other investors. For example, under the growth investing screens, we can see this one from Peter Lynch. This is a screener that's set up based on the approach of former Fidelity fund manager Peter Lynch. And we can see that over its lifetime, it has returned 300%. You can come in here and use this screen as a shortlist to figure out what stocks meet Peter Lynch's investment criteria, and either shortlist the stocks to analyze some of them in more detail or just invest in all of them. One way I like to use these guru screens is to look at what rules they have set up and then try to understand why they're using these particular rules. This helps build my own investment knowledge and lets me decide if I want to add these to my own custom screens as well. I just want to say that while Stockopedia is sponsoring this video, I'm not required in any way to give my own opinion on the platform, but it has saved me a ton of time while looking at different earnings reports, and the screens that I set up make it super easy for me to identify new stocks that I might want to look at. But we're not quite done yet. Step number 15 to answer is, would you stay invested or buy more shares if the stock price declined? When we invest in stocks, we want to invest in value. What is the company itself worth? And value is not the same thing as price. When you go to a store and you buy a coat, would you buy a coat just because it's cheap? Or would you rather find a good coat and then try to buy it at a discount? The price of the two might be the same, the cheap coat versus the nice coat that's discounted, but one of them is obviously more valuable. And then if the price of other coats on the market decreased even more, would that cause you to sell the coat that you already bought at a discount? Well, it shouldn't. It should make you go out and buy even more of those coats that you can flip them when inevitably the price eventually reflects the value. It's the same thing with stocks. In the short term, the stock market is a voting machine. The price can be anywhere, but in the long term, it's a weighing machine, and the value of the stock is the weight that affects the future price. And that's how you can have companies like Nvidia stock that I showed you at the beginning of the video, which was already worth $300 billion at the start of the year, but has still managed to nearly triple in value to an over $1 trillion market cap today. So number 15 is a check. Now, if we add up all the different checks that I've made, we had 13 yeses and only 2 nos. And in order to invest in a company, my goal is always to have 12 total yeses before I invest. So Snowflake passes the test, and that's why I invest in the company. So thank you, Stockopedia, for letting me play around with your platform. And if you're interested in signing up for yourself, you can sign up using the link in the description to get a 25% discount on any annual plan. And that's in addition to the 14-day free trial so that you can try it out risk-free and see how you like it. So go ahead and use that link in the description to sign up so you can be a cool kid like Warren Buffett. And I'll see you next time.